firing on all guns, actually. The market now at the high point, up about 0.5%. The space that's doing really well today is consumption. A lot of the FMCG stocks, that is, Marico, Bata, Pidilite, Colgate, Avenue Supermarts, all at new highs today. And not just 52-week highs, lifetime highs for many of them. Huge volumes as well. So I guess no one is concerned anymore about valuations and the stretched multiples there. But let's get in some market opinion. We spoke with Saurabh Mukherjee, the founder of Marcellus Investment Managers, and he says the market, barring financials, appears to be very well placed. Especially, he's expecting a pickup in private corporate capex. Listen in.
I think crude is really the big thing which has swung for India. So whilst the politics has become incrementally trickier in the last couple of months, crude swinging from 85 to 57, this is Brent, I think it really has made life easier. NBFCs and the NBFC finance piece apart, the rest of the economy and the rest of the market's looking up. My reckoning is the combination of a benign macro, which I think we certainly have going at the moment, and a capex recovery on the other side of the election, suggests to me that FY20, there's a decent chance FY20 brings an all-time high. I'm not so sure FY19 will bring the all-time high. And if crude stays where it is, I think the macro will become incrementally more positive as we approach the elections. My reckoning is between September through to Jan, the RBI will pump in around $25–30 billion. That's almost 1% of GDP into the market. But also, we can see alongside that the money market isn't getting any easier. The 10-year, the spread of the NBFC paper against the corresponding duration government bond paper stays very tight, right? So 10-year bond deal is coming up, but the spreads for the NBFCs is staying tight. I think banks are looking like a smart place to be. Banks will not only benefit from the mark-to-market on their government bond portfolios, but there does look like an incipient capex recovery underway in our country. The first early signs that with the capacity utilization rate in our country hitting 75–80%, corporates are thinking about capex. It will probably pick up pace on the other side of the elections, but I think banks are your best play at the moment on an incipient capex recovery.
All right, so those were some market opinions, but flashing on your screens is the clarification coming in from PNB Housing Finance, which says not aware of Carlyle really eyeing additional stake in the company, but then company will always say not aware because it's PNB, the parent company, which has over 30% stake, which has been on the block, which even we reported. So this is the clarification at this point coming in from the Housing Finance company. Now, through the end of 2018, now we are recapping the year gone by through the sectors that impact the markets as well as the economy. Here we have with us Nigel, who is taking a look back at the cement industry today. Nigel, over to you. How has the year been?
Well, to summarize this year so far, the volumes have been good, capacity utilization levels have been good. What really spoiled the party was, in fact, the input costs did spike up. So if you look at the capacity utilization levels, well, you'll see that it's been moving higher. In the last couple of years, it did see a bit of a dip, but now it's back at around that 67% odd. So no worries in terms of capacity utilization. The problem came in when petcoke prices moved from around that $90 to $100 per ton all the way to around $120 per ton. But good to see that as well has cooled off from the recent peak. Now, if you're looking at, what exactly happened to the profitability, then that dipped by around 60 to around 70 rupees on a per ton basis because of the higher input cost, and the selling price didn't go up as much. Well, there were a couple of big deals as well that took place in the past year. The big one, UltraTech and Century Textiles, we awaited for many years. Now it's come through. UltraTech Cement will take over nearly around that 13 million tons odd. There's a merger ratio as well that was firmly in favor of UltraTech Cement. Century Textile shareholders weren't very happy, but it was a good deal, remember, for UltraTech Cement, because it trades on an EV per ton of around $200 or thereabouts. They're getting this entire entity at an enterprise value of around 8,600 crores. That's including the debt number of around 3,000 crores. And they're getting an asset at the cost of a greenfield project. So that was a positive. There's a big difference in terms of EBITDA per ton as well. Nearly around a 400 rupee difference between UltraTech Cement and the Century Textiles deal. So to sum it up, it was good news because the valuations were good. It'll be EPS accretive from the day one itself. And when a stronger player is taking over a weaker player, there's a likelihood that the weaker player's EBITDA per ton will move towards the stronger player's EBITDA per ton. The next big deal was there was an engagement between Dalmia Bharat and Binani Cement. Well, that got broken off, and ultimately, Binani Cement has gone to UltraTech Cement. For UltraTech Cement, it was important. They wanted to hold on to their turf. Dalmia was attempting to move into a new geography. Now, the most important part of this deal, and why was Binani cement so wanted in the industry, because it has limestones of around 380 million tons. The capacity was around 6.25 million tons, which can be scaled up as well. The winner, that's Ultratech Cement, they in fact were very, very happy because they get 10% additional market share in North India. Not just that, the capacity in fact moves up and they have a scope to increase capacity to around 10 million tons odd. Though for both the parties, that's Dalmia or Ultratech Cement, it would be EPS dilutive for the first couple of years then. So that's what happened in the past year. In terms of profitability for the cement space on the whole, it was down by around 5%. But there's some good news maybe for the second half of the year because input costs have cooled down. Coal prices have cooled down. You have pet coke prices as well have cooled down. And when we talk about crude oil prices coming down, so that's good news. Input costs comes in lower. Now all eyes are on the cement prices. Can cement prices move up from here? And that's what will help them in terms of an EBITDA expansion in the coming quarter, at least in quarter 4. Those are the graphics up for you. Pet coke, coal, as well as crude prices, and also the axle loading norms that will reduce the freight cost by nearly around 4 to around 5% odd. So the industry is bracing itself for better times, rising demand, improving capacity utilization levels, as well as cost inflation could be coming in lower. So let's see whether or not quarter 4 is a much better time for these cement players.
All right, thanks for that. That is the finance minister speaking. So let's cut across to him.
As to where we really need to move. I think when we determine the strategy for New India, we also look at where we stand today. We stand at a very important era in Indian history where we can make up for a large number of lost opportunities of the past. Now, whether it was the fact that we were under a foreign rule in one generation, and then we came into an era of regulated economy, and thereafter we liberated ourselves and came into an area where slowly we started opening up and allowed human energies and human resource being unleashed in India, entrepreneurship being unleashed in India. And unquestionably our experience has been that a society which doesn't grow will never have the adequate resources itself in order to service the poor and get millions out of poverty and give them a good quality of life. And therefore, when we passed through an era where we had slow growth rates, bulk of our planning was regulated around the fact that either the state has an opportunity and we would supplement the rest with slogans. Slogans were never backed up with either resources or they were never backed up with any significant or material change that took place on the ground. But today I think situation appears to be different. And it appears to be different because having experimented various models, I think the debate has unequivocally been settled in favor of the fact that the economic model that we have been moving towards post 1991 certainly has paid very large dividends to India. But then, how do we tackle the problem of poverty? How do we still get millions who live in unacceptable conditions out of that? And therefore, our entire emphasis on reforms, on market reforms, on allowing entrepreneurship to grow, really has to be accompanied by some social consciousness of the economic planners. And that is why we've evolved this model where you allow India to grow, you allow entrepreneurship, you allow private sector to play a very important role, you get the government in to supplement where private sectors are not available, and you utilize these increased resources of the government, of the state, towards a better infrastructure, better townships, better healthcare facilities, better educational opportunities, and you put a large part of it as a resource in order to service the poor. They could be urban poor or they could be those living in rural areas. And the last few years that we've had these programs go on at a fairly rapid speed, we can see the effect of the change. And the change itself has been instrumental in raising the level of popular aspirations. So the aspirations are growing, people are becoming more impatient, they want things to happen faster. And therefore, if we look at the various verticals in which the Niti Aayog's proposal for a strategy for New India, it really encompasses all areas. How do you grow in areas of science, technology, education, healthcare, social sectors? How do you eradicate poverty? How do you concentrate on better infrastructure, better smart cities, and so on? And it's a fairly comprehensive agenda that they've laid down. And I have no doubt in my mind that we still have a long way to grow. The course that we have adopted is now gradually perfecting itself as the Indian model, in which you grow faster, you utilize the resource of the state in order to pull out millions of people out of poverty, give them a better quality of life, and improve the quality of infrastructure and other townships and smart cities, so that you create an environment in which the positive circle of India growing faster itself gets aided. Each decision is really aimed in this direction. I think when you think in terms of sound policy, the obvious debate whether sound policy pays more or slogans pay more. In democracies, these debates always will arise. Slogans have a transient life. They get found out. If they are not implemented, it doesn't take a decade or a generation to realize that they've been not implemented. The aspirational people, the people with a high level of aspiration and a very low level of patience now,